Welcome to the XY Advisor Podcast, a global community of financial advisors sharing and learning with one another to drive the positive evolution of financial advice. To get involved, go to xyadvisor.com or simply download the XY Advisor app. This series is brought to you by IDII Australia, committed to working with advisors to protect the financial health and welfare of more than 3 million Australians. In 2020, AIA paid over $2.2 billion in claims. That's a little over $42 million each week, and clients needed it most. AIA Australia would like to help you arm yourself for your next client appointment with this 5-part series into Australia's income protection industry from the 90s to now. Strengthen your knowledge and conversations with valuable insights from a panel of speakers from various backgrounds, exploring how the new generation of IP products can help your clients. Welcome back to this episode, the 5th and final episode in our 5-part series on IDII. In this particular episode, we are diving into the future. What could possibly happen from here? And we ask our expert panel to comment on all sorts of things around what they're expecting the future may hold. Welcome back, Katherine.
Good to be back.
We are talking about the future. Where to from here?
Mm-hmm.
Tell us about what are your thoughts on where we're at now and where we're heading.
Well, I feel like obviously we've had so much legislative change. We've had all these product changes. I feel like we're in the middle of it. I think is a good way to go. We had the loss of agreed value March 2020. We've had these IDII changes October this year, but we've still got the APRA changes to the 5-year renewal contract term scheduled for next year. So timeline-wise, I feel we're in the middle of the mix, but obviously all the insurers have come out. They've got their offers on the market. I think everybody's looking and peeking into everybody else's PDSs. And so I actually expect to see a little bit of copycat and adjustments, especially if some of the insurers start to see some new business drop off as a result of, not being as competitive as their fellow insurer.
Yeah, I think you're absolutely right. I feel like there's the water levels. It's like a little choppy ocean at the moment. There's a lot of water up and down, and that'll start to settle down where people will sort of end up bringing their products closer. So that means, I guess, a little bit more disruption for advisors then as products change.
Absolutely. I think you're going to have to allow quite a significant amount of time to familiarise with the changes that have happened to date, but also be quite cognizant of the changes that will inevitably come out over this next 6 to 12 months. And then, of course, we've got that 5-year contract term. So,
tell us about your thoughts around the 5-year contract term. Where's that going to go?
I think that's fraught with danger. Administratively, I don't see how it can be achieved. I honestly believe that the intent of it is to ensure the sustainability of our industry. I think the changes that we've just been through will do the majority of that. So that 5-year contract term, I do think it's largely unnecessary, and the risks absolutely outweigh the benefits. Some of the things I've spoken about on the task force is I have significant concerns around working parents, because we all know that home duties is not an insurable occupation. So if a 5-year renewable term comes up while someone's on parental leave, the intention is that you're not supposed to have a loss of cover because of medical reasons. Only occupational and pastime changes, but it's a temporary situation. So you could have a parent who has lost their covers because it renews in that time frame. And then when they go to get that cover back, it's likely, because pregnancy is pretty tough on the body, that when they do get that cover back, it'll be on potentially with exclusions. So it's failed that test of not supposed to have a detrimental impact on the medical reinsurability. So there's issues like that have to be played out. Then you've got the debate of if it's a new contract, does new business commissions apply? That's going to get expensive for the insurers if that's the case. I understand that I think they're going out getting legal opinions on that one at the moment. And then there's the whole having the appropriate IT systems in the background to be able to administer those changes, and what is the role of the advisor in all of that?
So many unanswered questions when you put it that way.
Yes, a significant unanswered question. So, but that would make it more akin to the group space, but with an individual underlay, because at the moment, when the group insurers go out and do that, they just put it out to tender. And you don't really get a say in the matter. So there's some similarities to that, but of course you've got that individual assessment and individual adjustments being made. That adds a lot of energy, cost, but that's going to just drive prices up. That's the opposite of sustainable.
Yeah. Now we've seen. You mentioned APRA in one of the earlier episodes. We talked about the concept of in the health insurance industry, for example, APRA. Once a year they approve premiums and pricing. And do you see that could be something that APRA step in and look at with?
No, they've made it really clear that they're not a pricing regulator. So that's not something that they want to dabble in. Even when there's been complaints about some of the insurers having excessive upfront discounting programs, they've said, look, we don't actually think that's an issue, despite most advisors saying, look, if you're putting a discount on a policy or a product that is known to be unsustainable, how can that be meeting the expectations of what you'd think APRA would expect? But they've just simply washed their hands of it. So I can't see them stepping in to look at the adequacy of premium increases or the appropriateness in the future. But what I am hoping to see is that they will start to track the rate of change for premium increases. But that will be quite difficult because, as we know, it's not just the same rate for everyone across the board. It's applied based on gender, occupation, where you live, makes it quite difficult to track.
Yep. What are your thoughts on premiums moving forward, both old product and new product?
Well, the old products, I think we're going to see those premium increases. It's going to happen. The new products, I think we'll see adjustments as far as insurers adjusting their products to find where they sit in the market. But there is always going to be that extra emphasis on making sure that cover is sustainable. So I'm less concerned about the new products, but, it would be foolish to think that there wouldn't be pricing adjustments.
Yep. And what about commissions moving forward? What are your thoughts on what that might look like in the future?
Yeah, I don't have any. I don't have any fear about commissions being removed from the industry. I think that the early outcomes of ASIC's review shows that there has been improvement in the quality of advice. We've also seen comments from the opposition talking about they're starting to soften their view and understanding, having reference to the overseas models, that it does seem to have a place, but they're quite cautious with those remarks. So I think that given that, I'm not planning to adjust my business model for the loss of commissions. So I'm not too worried about that.
Now, in previous episode, we touched on advice affordability in risk moving forward. What are your thoughts? Are we going to start seeing non-advised products kick in, the robo type stuff? If advice affordability?
I have mixed feelings about this one, because at the end of the day, one of the things that helps make insurance affordable is having enough lives in the pool. So you kind of want to get as many people in, which takes multiple channels, whether it's direct, whether it's group, whether it's advised, or general advice, which is that sort of grey space which everyone's trying to work out where it fits and how compliant and how to do that, and without actually stepping into personal advice. So that's quite tricky. So as far as that goes, the more lives that are there, the better. So that means there should be more channels open, but as long as it's done with the right knowledge behind it, the clients being fully aware of buyer beware versus I don't know. It's just a minefield on that front.
Talk to me about the concept of risk specialist, because this has moved. We've seen, obviously, the term's been around for a long time, but is there something now as we move through the future? Is risk specialist going to become even more so? Holistic advisors won't do risk anymore; they'll refer it off. What are your thoughts?
Yes, that's my prediction in a nutshell. I think that we're definitely going to see the rise of the risk specialist. It's interesting. I was looking at came across some data which was saying that while there are many advisors that write risk, I think it was an NMG report that indicated that there was only about 400 risk specialists across Australia. So out of all the advisors, there are a lot that touch risk, but not many that specialise. So it will be interesting. I don't know what the demographic is of those advisors to see what happens up to 2026 with the education side of things, what happens there. So, but what I am seeing is more advisors who dabble in risk are moving away from it. They're recognising that the complexities are there, the remuneration is down, and unless you're doing it day in, day out, it's quite difficult to be on top of it. So the downside risk far outweighs the benefit. So definitely seeing more advisors step away. But I have seen the alternative where some generalists have gone, if I want to do risk, I'm going to just do risk now. So I'm seeing that as well. But usually it's more the people exiting the risk space. But I think the real danger is that given the low entrance to our industry, unless you've got full practice advisors switching to become risk specialists, it will take a really long time, because if someone's going to go study a degree in financial planning, I can't see them in a position where they're going to go, let's just focus on insurance after studying everything else. So I think it will take a long time for numbers to recover.
Yeah, interesting. So we need the risk specialists, but it's going to be hard to find them.
Correct. So that's good if you're a risk specialist and you can do it well.
Yeah, there's definitely a supply and demand equation to be spoken about there. Big picture, looking out, disruptors, the big tech companies, the Facebooks, Amazons of the world. How do you see them playing a role in the future of risk?
Well, look, they're going to. I would actually optimistically say I hope they do break some ground, because I would rather have someone with a big business with a big budget break the ground on how to master, say, for example, general advice, and have them put their butt in the fire and make all the mistakes, to allow, the rest of us to learn the lessons of what not to do before dabbling in that space. So, I don't think it's a bad thing. I think we need more people seeing life insurance and protecting your loved ones as normal. And if it takes a couple of big corporations to throw money into getting that message out there, then that's a good thing. It's like those horrible life insurance ads on daytime TV. It's like, I hate those products, but I like that they make people think about it. Like I said, so it's pick your battles and focus on how you can use it to your advantage.
Wonderful, Katherine. Thanks so much for coming on and chatting to us all about the IDII changes. How can people get hold of you if they want to continue the conversation?
Yeah, absolutely. So people can always shoot me an email, which is just the letters KH, my initials, at hcis.com.au, or you can head to my website. I actually have a Calendly plug in there if you wanted to book in a Zoom, phone, or other catch-up, which is just hcis.com.au. Thank
you. Welcome back, Jeff.
Thanks, Fraser. Good to be here for the final one and look towards the future.
And yeah, great. Yeah, I'm looking forward to it as well. So thank you for joining us for the entire series, actually. But look, we are talking about the future in this one. We've had the changes come into effect. We have some certainty around what it kind of looks like. But as we move forward, there's still a lot of uncertainty, I guess.
Yeah, there is definitely. We're still getting our head around the new products and how that impacts on existing books and for new clients. And I guess we're expecting changes in those products as well as the insurers realise where they're sort of sitting with their competitors. And still a fair bit of uncertainty. And I think, a little bit of cynicism from advisors, and I'm no different in that we're talking about sustainability, and that's why we've made these changes. But, have they got it right? Are the products going to be sustainable, or are we going to be having the same conversations in 5 years' time? And in 10 years' time, I might not be here, but in 5 years' time, hopefully we're not having the same conversations.
Yep. So obviously the new products have launched. They're all very different. It's not like we have different flavors of vanilla on the market anymore. We've got a whole lot of different varieties to choose from. Do you think over time, though, there will be a more of a coming back to the middle in these products, and maybe if something's working really well, then the other insurers will then jump on that as well and launch similar products?
Probably. I don't know that's necessarily a good thing, but I think probably it will. I guess there may be an element of, with a smaller audience of specialist advisors who are doing potentially more business, maybe there's an ability to be a bit more niche and focus on, what do we do really well, and work with advisors who support that philosophy, as we touched a little bit on in that previous episode. It might be a case of certain product providers come out with products which suit certain styles of certain philosophies. But I think, unfortunately, the way the compliance regime is built, it's got to be based on, how do you support your view of best interest, and comparisons is a tool that you're doing there, and if they're so far apart you can't compare it to anything, then that makes it quite hard to back that up, and compliance teams and lawyers will get nervous about that, so insurers may be forced to sort of come back towards the middle a little bit.
What are your thoughts on, speaking of comparisons, what are your thoughts on the comparison software? Do you think that's going to become less important in the role over time?
Right now, it's largely irrelevant to us in the income protection space because they are so different, and it's so hard to just get an easy line up across them, and we're taking the time to learn more and dig deeper into the underlying products. I think risk specialists probably do that more consistently anyway, and therefore they rely less on the research houses. It's more the advisors who are doing one case a month, or the occasional client where they don't have that time or energy or expertise necessarily to go that deep on the products, where they have to rely on the research houses. So I think in that space, still going to have the same role to play. I think in the specialist space, which, as we talked about, is narrower and deeper, potentially becomes less important. And as I said, in the short term for us, it's almost irrelevant because the research houses can't line up those products as they used to.
And do you think as you mentioned, risk specialists, and you sort of touched on in the previous episode with some of the stats around that, but do you think the risk specialists will now segregate or split off over the next few years and become a complete specialty?
I think it is already to a degree. I think some people are doing it really well. I mean, we appointed in our business a risk specialist earlier in the year, and he's fantastic. Dom's doing a great job, and I'm really glad he's here with all these changes going through. And that was a choice we made. So I think there can be opportunities for businesses to bring that within their team. But there are also, I know, some really great risk specialist businesses out there. And I think to do it properly, you need to have that extra time and energy and resource available.
And obviously, commissions has been a big part of insurance over its history, lifetime, you could say. Moving forward, though, obviously we've seen some reductions in the past. But moving forward, what are your thoughts on commissions? Well, is it going to be something that future governments might rule out, or what are your ideas?
It's a challenging one. I think the Labor sort of flagged that they were not very keen on commissions, but they seem to have softened their stance in recent months, which is good. And I don't think they're saying we're all for it, but they're saying we're happy to be convinced that it still makes sense. I think in the main it does make sense to maintain commissions, but I think we've also got to be mindful that we have had commissions forever, and we still have underinsurance, and we still have challenges in this space. So commissions alone isn't the answer. It's not like just because if we increase commissions, we're going to solve underinsurance is kind of not the positioning. But I do think the nature of the insurance process is that, it's challenging if there isn't success in getting the business in force for somebody to want to pay the fee that it might cost to get that business in force. And so a commission structure works well. Also for lower premiums and lower value clients, it's a really important way of getting them into the pool and getting them covered as well. So I definitely believe there's a role for commissions to be played to play. And I think, government and regulators in the main understand that it's something they need to consider and keep on board. But I wouldn't hang my hat on it.
Yeah, fair enough. It's an unusual one. If anything, it kind of feels like commissions might have gone a bit low. I don't know. What are your thoughts?
Yeah, I think for the upfront particularly, it's really hard work to get insurance on the books, and a lot of them don't actually go through these days, or don't get accepted at the end of the day. So yeah, I think on the upfront particularly, it's gone a bit low. I think on the ongoing, it's probably okay, because you've got some clients who need a lot of maintenance year to year, other clients who who don't for that first 2 or 3 years. Once you've set it up, it's kind of just checking in. Yeah, it's still pretty relevant. There's not a lot to be changed. So probably on that evens itself out on an ongoing basis. But I think up front, I think it's gone too low.
Yep. Now, the first I in IDII stands for individual. We haven't sort of touched on group really in this scenario. Do you think group insurance will end up with a similar following suit to individual?
Yeah, I think so. I think it's already started. The price increases that have gone through group insurance are pretty significant in recent times. We don't have a lot of exposure in that space, but anecdotally, I understand they're starting to feel the pressure, and it's been retail cover has stacked up very well against group cover in many ways in recent times. I think there might be some tension in that space for the next little while these new products are sort of settling down. But I do think there will be changes in the group space probably because they're going to be facing similar claims experience and sustainability issues. So there might be some advantages in group in the short term, but that's not a long-term substitute, I don't think.
Yeah, and if we go way out and we start talking about the future and getting right out into the concept of what will advice look like in 10, 15, 20 years from now, the disruptives, the big technology companies, the Amazons and Facebooks of the world that know a lot of data around people or humans. Where are we going to be? Is this still an advised product, or is it going to be a lot more individual, non-advised products?
I still think insurance is an advised product. I think there's complicating factors. I think there's a role to be played for I don't know if robo is the right word, but more technology-driven options within the space. So I would like to see that improve, but I would like to see that sort of improve in conjunction with advisors. So how can you make it a process which the client can do a certain level to themselves, and then if they want some advice or they need to go to the next level, and that's I should have a similar view from an investment viewpoint and a sort of holistic advice viewpoint as well. But I think there's some opportunities there where certain clients don't necessarily need the detailed level of expertise and understanding that an advisor who's a specialist in this area, which I think is where we're going to be heading at least for the next 5 years, can bring to the table. But they do need some cover, and we can get started, and then they'll get to a point in time where they want to have a conversation, and if we can make that easier, that'd be great.
Brilliant. Thank you, Jeff, for coming on and chatting to us on this series, all things IDII, which is a pretty hot topic at the moment.
Sure
if somebody wants to continue that conversation with you, what's the best way they can find you?
On LinkedIn. I tend to look at LinkedIn fairly regularly. So just look at my name, Jeff Thurecht. There's not many Thurechts out there, so you should be able to find me. I like to look at LinkedIn regularly, so have a look there. Or look at Evalesco and then shoot me an email through their website.
Wonderful. Thanks, Jeff.
Thanks, Fraser.
Thank you for joining us, Natalie Cameron, in this final episode of our series.
I really enjoyed having this chat, Fraser, so thank you for inviting me back again.
No problem at all. Now, we're staring into a crystal ball and gazing into the future of what that could hold, which of course means none of what we say could be correct. It's all based on none of it's based on past performance. But tell us about what your thoughts are with regards to. Let's start with the concept of insurance specialists, because it's sort of becoming a very difficult field for a lot of sort of holistic advisors.
So Fraser, by insurance specialists, you're talking about people who focus solely on risk rather than sort of financial planning more broadly. So if I've got that right, I think I personally have seen some amazing advisors in action in the past who are risk specialists. I've seen, we always talk about the poor outcomes, the claims denied or the products lapsed or whatever it is. We don't talk nearly enough about the amazing outcomes, and that was sort of multitudes more frequent for me in my past roles than the negative outcomes. I think there's a continuing and growing space for risk specialists. It is a really complex field. It is something that people need help with, and people need advice on, and I hope to see that that profession flourish in the future.
Yeah, exactly. And you've mentioned before the tailored suit. I hate to keep coming back to this, but you mentioned before that's certainly a skill. But you also mentioned the blanket concept, and it could be fair to say that when it comes to, say, advice affordability, it's not that we've just made things a little bit more complicated. So let's maybe make an assumption that advice affordability is not coming down anytime soon, unless, of course, we get something that can then help cover. Again, if I think about the blanket, cover some of the masses, obviously groups there in many ways. Well, do you think that we'll see that happening, where there'll be specific people getting advised, or the tailored suit, and other people getting the blanket?
Well, I mean, my hope would be that more people can access advice. In the future, I think there should be so much more of it. Good advice. I think there's a great need for it. And when I see, AFCA handles complaints about advisors. I'm not sure if you know that it's less than 2% of our incoming complaints are against people who identify themselves as advisors. The vast majority of our complaints are against other financial firms. It might be insurers and banks and superannuation funds, platform providers, all sorts of other financial firms. When I talk about advice in the future, when you ask about is there a place for risk specialists, I think there should be more advice. I think there's lots of situations we see, lots of complaints we see, where I think had there been good advice, we wouldn't be receiving the complaint. So absolutely space for that in the future.
Yeah, it's really interesting, the stats around advice-based or advisor-based complaints versus product-based complaints. And I guess that probably comes back down again to that communication understanding, where advisors are probably doing a good job of letting their clients know in advance, what to expect.
Yeah, well, I mean, that's part of the obligation. That's part of the responsibility and the job. It's really important for advisors to outline the risks and the compromises, as well as the benefits of the product that's being recommended.
Yeah. Expectation management seems to be, again, a huge piece of this jigsaw puzzle. And when I think of some behavioural economics around how we as consumers treat insurance policies, and if I want to throw the health insurance under the bus here, it kind of feels like, as you and I sit here looking at each other, we're both wearing glasses. We've probably claimed glasses on our health cover or whatever it might be. It kind of feels like we live this process where, as consumers, we think we've got this insurance. We need to claim on it at some point.
It's an interesting one, isn't it? I mean, I guess I see the benefit of having health insurance as a different benefit to having life insurance, and really with life insurance, it's it's sort of the being able to sleep at night. Well, it's really with both, but it's kind of those things that could keep you awake in the middle of the night, that you then think, well, I'm responsible for these kids, I'm responsible for this mortgage, and the school fees or whatever it is, but I have something in my back pocket that's going to make me feel good about getting about my daily life. I'm not going to think about it too much, but when I think about it, I'll get some comfort from it. There is benefit in that to me, as well as benefit in making a claim when I need it.
Yeah, I love the concept around the expectation management around saying that the best case scenario here is that all of these premiums were a waste of money and you didn't need the cover, and so the best case scenario is you're healthy.
I'll take not claiming as my best possible outcome.
Yeah. So we covered off a little bit on group being that blanket or that getting in place, helping a lot of people get cover. How do you see group in the future? Are they, is group going to go through some changes like individual has, or?
Oh, look, it's, I'm sure that there will be changes. What I hope doesn't change is, the extraordinary superannuation and group insurance environment that we have. Just something to be proud of. Been, in lots of different countries and looked at the financial systems in various places. It's one of the benefits of working for multinationals. Look, I'm always so proud of our superannuation system and the way group insurance works. I think it does afford cover to an enormous number of people who might not otherwise be able to afford it. In the past, that has proven to be of great benefit to many of those people. And so I'm sure that there'll be changes. Nothing ever stands still, but I hope we retain that wonderful system alongside the equally and very different tailored personal advice industry as well.
Yep. There's been some, now we talk about income protection being the disability income piece of this jigsaw puzzle. There's some comments around or some ideas around that, trauma or crisis recovery could also be on a learning curve to say, take what we've learned out of disability income and apply it to crisis.
I feel like in the evolution of products, there will almost inevitably be some learnings as we take this big step change on IP. I think, from my understanding anyway, or my experience, and it's certainly not everyone's experience, but I do think it has been the IP cover that has been the significant issue. But I'm sure that there'll be learnings for trauma, TPD, and others.
Yep. Now we're at a place where as we mentioned, we've been through a lot of the changes. There's still some more to come. How do you think the products will start to settle? Will you see them coming together a bit closer, or what are your thoughts on how all that might work?
Look, I'd probably ask that question of our advice industry. I think these products. Anything new is going to seem alien, perhaps complicated, certainly different at the start. I can't help but think that that they will be integrated into different philosophies of how to make advice recommendations. They'll be integrated into different product suites and recommendations that certain advisors give to their particular type of client, and I think they'll become the new normal, and I'm sure that the advice community is going to adapt and change because I've seen them adapt and change to so many other challenges over the years that I've been involved in this industry.
Yeah, certainly resilient. Talk to me about the concept of rehabilitation. You've seen a lot of this over the years as you've worked in claims and claimants. The idea of helping people get back on their feet and rehabilitate has been such a big part of that claims process. Do you think that's going to sort of suffer a little bit in the future?
Oh, it's a fascinating question because shorter benefit periods or smaller benefit amounts could the assumption could be that there should be less invested in rehabilitation, but I think the rehabilitation that is being done now has been a wonderful thing for life insurance customers as well as insurers, and really a win-win for everyone. And I think it's really a drop in the ocean so far of what could be done to help those clients on claim. I just think there's so much more opportunity existing anyway. I don't think that these changes will mean that it becomes something unnecessary or not financially beneficial to invest in. I mean, for one thing alone, it is just a wonderful product offering of an insurer to offer not only to write the check, but also to support someone to get back to health. And I really hope that continues to grow and flourish, in the context of these new products as well.
Yep, couldn't agree more. Now, final question, just on the disruptors of the industry, the larger groups, the big tech companies. What any thoughts or ideas in years to come if we start giving all our personal information away to, say, a Facebook of the world, that they'll start being able to tailor insurance or those sorts of things and come in and look to disrupt the industry?
I'm sure that disruption is coming in one form or another. How quickly it gets here and changes things is another. I do think that there would always be a place for the personal engagement and face-to-face discussion about financial situation objectives and needs, about hopes and dreams, about fears, about family, about finances, that an advisor has with their client. And I think that relationship of trust, will continue to be an important thing. And the more advisors focus on that and work on that and continue to do that, the better. I don't think that's going away, no matter what AI can deliver in terms of tailoring to after reading your bank statements and your spending patterns and your various other facts and stats.
Natalie, thank you so much for coming on the series with us and chatting to us. I really appreciate your time, effort, and energy. Thank you.
It's been fantastic. Thank you so much, Fraser.
Thank you for joining us again, Ben Martin.
Thank you, Fraser.
Now, we are talking big picture, the future, things that haven't happened yet. Obviously can't hold you to any of these things because we don't really know what happens in the future. Tell us about, obviously we're at this place now. We've got these new products. They're just starting to settle in, I guess we could say. What does the future hold?
Oh, that's $1 million question, Fraser. I keep coming back to, and I obviously do not have a crystal ball, but I keep coming back to, we've got these new contracts that have been built with the one fundamental objective in mind, and that is to remove the nasty ad hoc rate rises and pricing pressures of the past. So when we look at the IP contracts now currently on offer, I'm hopeful that that the industry collectively comes together to go to the root cause of why we're having this discussion in the first place, that we don't lead and this doesn't result in another arms race in an effort to grapple for more market share, because I know our advisors, they won't be able to, it's just not going to be palatable from an advice practice perspective. Ultimately, consumers and Australians, they need this cover. They need these contracts to protect their income. And I note that even for a client that's got no levels of non-deductible debt on the family balance sheet, typically there's always going to be a meaningful place for an IP policy. So we're hopeful as an industry, or at least for me that works in the tech world, that we've gone and addressed the root cause of why we're having this problem in the first place. And we've got contracts that will remain fit for purpose and be liberated from those pricing pressures going forward.
Yeah. So learning from the lessons of the past, creating that stability and bringing that stability back to the normal part of an insurance portfolio.
Absolutely right. And I guess some of the downstream flow-on effects there is that, when you think about the end consumer, if they do suffer from a temporary illness, then these contracts are designed to, where practicable, transition the client back to wellness and back into the workforce, where we know that's going to be in their best interests long term.
Yep. Now, this is all we've pretty much been talking about individual the whole time. We haven't sort of touched on the group aspect. Obviously, individual was what has been changed first. Group is still yet to be touched. What are your thoughts on the future of how group and individual will work together?
Yeah, look, it's an important one. In terms of what's going to happen in the group space, I don't know, but the discussions that I've been having with advisors is around, okay, if I'm looking at recommending a new world IP contract for my clients that is seemingly much more plain vanilla compared with the old settings, then why would I not just nudge my client towards a group salary continuance plan? We're hearing that a lot, and it's a valid question. What we say as techos is that when we compare a group contract, a group IP contract with a retail IP contract, the similar principles remain as they did in the old world. Okay, so the things you need to be keeping a lookout for, particularly from a best interest duty perspective, is that group salary continuance contract guaranteed renewable? Is there a risk that the T's and C's within that group plan can be downgraded once the contract goes into force without the client even subscribing to it? That tends to happen. We see T's and C's within group contracts being downgraded, especially when a group super fund puts out a tender and reorganizes their underlying insurance arrangements and providers. again, there's a risk there that if the client has a group contract, that we're setting the wrong expectations from the outset, noting that they're having to pay the premiums along the way, right? Typically from their super fund. So guarantee renewability is one thing to keep a lookout for. The other thing to keep a lookout for when you're comparing group and retail is the definition of pre-disablement income. So within the retail space, generally you get a 24 to 36 month look back period for the purposes of striking the monthly insured benefit for the client. Within the group space, that look back period is much more narrow and confined and restricted. So that's not going to be of any value for those clients that have variable levels of income from year to year. The third thing to keep a lookout for with these group contracts, usually you don't have the ability to link an ordinary extras plan to the super owned group salary continuance contract. So that's code for massive alarm bells when it comes to meeting a super law condition of release at time of claim. If the client doesn't meet the super law condition of release, there's no second line of defense that they can fall back into within those group contracts. So there's a big question mark as to whether or not the client's going to be able to receive the monthly insured benefits when they need it most. Now, I'm not totally slagging off group contracts. That's not my intention. But for the completeness and for the sake of having a balanced discussion in this space, I think it's important to call out those traditional shortcomings of a group contract that may not necessarily be in the client's best interests as a whole.
Yeah, no, you're absolutely right. And as a techie in this space, of course, you see that very clearly. It's probably a little bit difficult. It's very difficult. It's probably easier for advisors to see, but it's very difficult for consumers to see that or to understand that part of, the value that comes with guaranteed renewable, the loss of control and ownership that happens in a group product, and the understanding of that. Whilst group plays an amazing part of getting a whole lot of people cover that wouldn't otherwise have it, how do we get that message out in the future to consumers that, just because it says income protection on the label doesn't mean you can compare with a retail?
Yeah, and this is where the value of the advice really emerges. And this is a crucial role that the advisor, this is a meaningful value that they bring to the table. They take that deep dive, they understand the client and make a recommendation accordingly. Without that detailed analysis, there's a risk that the client's going to end up with the wrong contract that's not going to meet their expectations when they need it most. And this goes to the heart of the issues that we're seeing in the industry at the moment. The cost of advice, as you know, Fraser, is escalating. And it's getting to a point where, as practice principles tell us, it's not commercially viable to service and provide advice to that mid-market of Australians that need advice the most. So it's fingers crossed, and we're hopeful that, these reforms, these APRA DII reforms, together with a broader review into the cost of advice, altogether is going to produce meaningful client outcomes for our industry and ultimately for Australian consumers in the end.
Ben, one of the things that I've sort of been discussing with some of the other people on the panel is the idea around behavioural economics, the way that we think about insurance as a product that we should be claiming on at some point. Same way as we probably all, if you've had health insurance, you might have gone and got your eyeglasses or some stuff done just to get some of the money back. How does that behavioural economics, from a point of view, how do you think that sits with income protection insurance and risk insurance, and how we sort of have to have a different outlook on that moving forward?
Yeah, that's a tough question. I'm not sure if I'm going to add much value here, but the analogy I draw in my mind is CTP, comprehensive car insurance. When are the benefits going to materialise for me as a policyholder? It's when something goes wrong. That's the parallel I'm drawing in my mind, Fraser, with an IP contract. Yes, I'm paying the premiums along the way, but the benefits will tend to materialise when something goes wrong. To soften the blow, so to speak, if I can use the right words there from a behavioural economics perspective, looking at this, standing in the shoes of a consumer, the one thing that may soften the blow is the fact that if it's a self-owned income protection policy, I'm entitled to a tax deduction for my premiums. So whatever premium's being quoted, whatever that headline premium is, that's not reflective, as our advisors know, of the hip pocket cost of holding that policy, unlike a comprehensive car insurance policy where it's obviously a non-deductible expense to the family budget.
Yep.
That's how I would kind of frame.
Yeah, it's a good way of framing it. Now let's push ourselves out into the future. 10 years from now, looking back, how do you think all these changes have settled in?
Well, I'm hopeful. I'm hopeful that we've got IP contracts. We've got a good proportion of our Australians that hold robust income protection contracts that are liberated from those pricing pressures of the past. Because let's face it, the more susceptible these contracts are to pricing pressures, the greater the risk that they will lapse and they won't be in force at the time when Australians need them the most. So I'm an optimist, but in my mind, in 10 years' time, I'm hopeful that the industry has settled, the dust has settled, all of the steam has come off, both the regulators and us as professionals and Australian consumers, and that ultimately we've got stability in the pricing structures, not only for IP contracts, but life insurance, crisis and TPD policies as a whole.
If you're interested in continuing this conversation with Ben or any one of the team at AIA Technical Education Centre of Excellence, you can hit them up via the email at tece@aia.com. Check out their business growth hub for AIA Technical Services, or just contact your local AIA BDM. Thank you so much. Really appreciate it. We look forward to catching you very shortly.
Thanks for having me, Fraser.